I will start my talk about the art and science of trading options with a brief look at the Black Scholes equation. It is the cornerstone of modern option trading, whether you think it's a good or bad formula. As a recent YouTuber called it, the $1 trillion equation, it indeed is, although Black and Scholes were not the originators of the idea. It was the French mathematician Bachelier in 1900, no less. However, the actual solution, which was used by Black and Scholes, was derived from the later Nobel Prize-winning heat diffusion equation of Einstein, which was a differential equation to solve the jiggling of particles under heat pressure, atomic particles, subatomic particles or whatever, and I won't go into the detail of how it links back to Bachelier's paper, but Bachelier's was unknown and didn't influence Einstein, but it predated Einstein and it showed a brilliant mind which was neglected. He wasn't recognised for his true achievements till long after he died. Happens in art, it happens in music, it happens in quite a lot of fields. It is an unfortunate fact of life. There are a lot of people who get a lot of accolades and who don't deserve it, not in their life or after their life or ever, and some that do don't, which is sort of in keeping with the randomness that they found in the basics behind option trading and share markets in generally. It's not so much randomness, it's chance. Chance is not exactly randomness, but I won't go into that too much. It's similar. Well, I suppose it is indistinguishable, but I think there's a fine line. Randomness is unpredictable completely. Chance, on the balance of probability, you can guess to a certain extent. That's my definition anyway. Anyway, we'll look at the Black Scholes formula. Now, I've rewritten Espen Haig and Dieter Wertz from his R-Metrics F Options Library formula, and Espen Haig published his book, The Complete Book of Option Trading, twice. I think the last edition was around 2007. And he put basically all the options code into algorithms, of which I've converted here. And it was a basis for a lot of the F options code, except for, I believe, the code on the Heston-Nandy model. That was created originally by Dieter Wertz. Dieter Wertz passed away in 2015. And the library is no longer on R. It's been deprecated. So, yeah, you can't use it. I used it up until about a year or two ago with a bit of trouble, but it no longer runs at all anymore with the latest version 4 of R. And so I converted the formula to a function. I'm trying to save all of the metric stuff because it was very good, and add some of the more formulas from Espen Haig's book. Now, before I run the formula on Black Scholes, there's a famous quote about Black Scholes. I can only sort of roughly paraphrase it, that it's the wrong formula. It's the right formula for the wrong result. It's not a very elegant translation of it, but I can't remember the exact quote. And that is correct. If you use the Black Scholes formula as it was intended by its creators, you will lose a lot of money in it. It's a terrible formula. It's not good at all. And I think it's been the ruin of many a hedge fund and many a... well, it was the ruin of one of the largest hedge funds ever. The creators of the Black Scholes formula were part of that hedge fund, LTCM. So I wouldn't have too much faith in the Black Scholes formula. The only way the Black Scholes formula is useful, the price it produces when you put in all the details, the interest rate, the stock, the expiry, the time till expiry, and the volatility, will give you what it believes is a perfect equilibrium price, and we know the world is not an equilibrium world. Neoclassical economics is bunk rubbish, and so is basically the efficient market hypothesis. The only way the formula works is to put the market price back in to the Black Scholes formula and set the volatility using either Newton's method of gradient descent and using Vega, the derivative of volatility of the Black Scholes formula, to solve with Newton's derivative, Newton-Raphson method, or the quickest and most efficient way, because that way the Newton method doesn't always find a solution. You will always get a solution with the, I call it the high-low method. What's it called? Interpolates between two values till you get to the exact value. I'm unsure of what the exact name of it is now. You can look it up. It's the easiest method, and it's implemented in a lot of books all over the web. I'll show a link to it at the end anyway. Now, once you get the volatility from the actual share price, you'll get what's called the implied volatility. Now, the implied volatility is the crucial part behind the whole of option trading, believe me. It's not matching prices or inefficient pricing or any of that rubbish. Volatility arbitrage is the secret to option trading. Not necessarily always volatility arbitrage. There's conversion. There's discounting. There is discounting, yes. There is mismatching prices, but you have to do it with realistic prices. Now, once you get the implied volatility, what that is the market's, the volatility of the option implied from the market. The market rarely values the volatility at, some sort of equilibrium price. Options are generally overpriced, but there is periods of underpricing. As a general rule, and in future series in this series I'll go into more detail, when the historical volatility is greater than the implied volatility, it's a time to buy options. Now, I'm not an option buyer. I don't see it as a good strategy. You can synthetically buy calls by selling puts. I know you don't make as big a profits if it really is a definite upward movement, but I'm happy to take a fixed amount. The other side of the equation is when volatility is higher, implied volatility is higher than historical volatility, with time decay it will generally decrease. There's not a guarantee that this will happen, but it happens on the balance of probability most of the time. So generally, selling options is a better strategy. You don't make as big a returns when things shoot up, but you make more certain returns more often. Anyway, we'll get on to the Black Scholes formula here after my ramble. Now, we use library Pragma because it's one of the main mathematical libraries in R. Now, of course, I've got dozens of formulas in Excel to do this, and I'll show you a free one on the internet where you don't have to have Excel and you don't have to have this. C and D, that's the function return P norm. That's the for the probability part of the equation. Here is the actual function. It's not that complicated. It looks a bit daunting to those who aren't mathematically inclined. And we run the function. And here we're putting a sequence of random approximations to a real trade to show the Greeks, which I'll briefly explain. The delta, that chart there, shows the for different expiries, for a vanilla call or a plain equity option, call, not a put, not the right to buy, not the right to sell. The slope of the change at different prices. For a $1 change in price, it measures the slope of the change. Theta measures the rate of decay of the option at different times. Vega is the change in volatility as time passes. And you can see it tends to go up till about, it tends to rise is the change in interest rates per change in dollar of the underlying. And you can see it tends to slope fairly evenly. This code will be available on my POSIT site, and I'll try and link it to my Patreon account. If I ever get that up running, it's up running, but there's nothing there. I haven't spent much time trying to set it up. I don't know whether it's financially viable. And alright, well, I'll pause here and then I'll add some more video. Thanks. I'll continue on here with the online website, which has the Excel code for all the implied volatility strategies and the option calculator. As you can see here, this has actually been Excel that's been coded into the web. The site is woption-price.com /implied volatility.php. But as it changes when you click optionprice.com for the basic, and then you can go through the menus. We'll just start with the basic. So you don't need my R code, or you don't need to write it in Excel yourself if you don't wish to. Here we have underlying exercise price, days until expiry, interest rate, dividend yield, volatility, rounding, 3 decimal places, graph increment, calculate, bingo, and we get the charts. $100 long call payoff, that's a payoff chart. For those who are unfamiliar, I suggest you familiarise yourself. I haven't got time to describe it here because this video has been going on a while. just trying to be as helpful as possible. I've got a few more things to say. And the long coil gamma. You can see gamma there, like similar to my chart, although can we select? Oh yeah, you can select here with the drop down. Long put theta. Ability to feed back into the volatility estimate. They've got a volatility, implied volatility calculation here. We'll just muck around with this temporarily. We'll say the underlying price is $30. We'll say the exercise price is, it's a put I'm going to use, $24. Oops. $24. And we'll put option. And days until expiration we'll leave at 30. Interest rate we'll leave. Dividend yield we'll leave at 1, yeah. Interest rate will drop a bit. It's not quite that high, I don't think. Say it's 3.5. Oh, 2.5. 3.5. Now, is there anything else here? We'll calculate. There you go. The implied volatility is 102.63%. Wow. Generally puts the volatility as high. Long coil spread, long coil butterfly. Let's see. My favourite strategy is either a covered call or a, where's iron condor? It must only be single wing strategies. Short strangle. See. The closest you can get is a short strangle. Oh well, that's a shame. Not quite an iron condor, but short strangle similar. Okay. Well, you've got all your stuff you need there for mucking around if you're not mathematically inclined with Excel, R, or any other program, and you just want access to these things. Custom. Oh, here's where you can do things like iron condors in there. Portfolio Greeks. Matrix. Oh, that's a pretty interesting table. It gives you volatility versus the underlying price, which is handy. About. Now here's where the code is available. It has a description of the option pricing calculator. It has a description of the Black Scholes with all the various formulas. And you can get the full Excel workbook with the code, so even if you do want the Excel workbook, it's available there. And here's a snippet of the VBA code of the high-low method, which I remember now is actually called the bisection method. This is the simplest code. It goes way back to the late Simon Beninga, professor at one of the Israeli universities, and he also taught, I believe, at MIT and a couple of other universities. His famous book, Excel Finance with Excel, and a few other books, was seminal for many years, but he passed away in about 2017, I believe. So his book hasn't been updated since then, but it's still a really great book. And this is where that's the source of this sort of code. It doesn't come from Espen Haig. Espen Haigs are a bit more complex. And yeah, there's help there from him. You contact him. He does have a site, this guy. I've followed him for many years, where he trades and he gives. Yeah, he makes money out of it. He provides a lot of free resources. He's great. He helped me a lot in the beginning, his free resources. So let's move on to this option profit calculator. If you can't get details for trades, this is really good because it gives you the current market prices. Like the market's closed at the moment. I'm doing this of a Sunday morning in Australia, a Saturday night in America. Yeah, you add the symbol, you add the current price, and so on and so on. Because I trade with Tasty Trade, and it provides all this information. This is only for people who want to do paper trading, who are just new to options. I probably wasted a bit of time here, so I'll sign off. Okay. Back to these briefly. Yeah, that was the prices. So at the it's new. At the end of zero, and so on for that. All right. This series is going to continue on. It's not going to be so rambling. It'll be a bit more professional. I just wanted a quick intro video. If anyone's persevered this long, I hope they found it helpful. I started with the Black Scholes, so I didn't go into option theory. It's not that helpful. Well, it is, in a sense, but you can grasp it intuitively. So I'm going to cover a lot of different option models, a lot of different option trading methods. I'm going to look at real trading problems and issues. It's not trading from a theoretical or academic approach at all, nor from a efficient market hedge fund approach. Small retail traders are in a different universe to hedge funds. I won't go into details, but they are. You cannot trade like Warren Buffett. No one who's a retail trader can trade like Warren Buffett. All those books are just rubbish. And all the many other methods, you cannot trade like, as far as Jim Simmons and Renaissance Medallion and the famous 66% for 39 years or whatever, actually, that's a bit of a misnomer. He used his famous, they did about 20% of their trading was actual market inefficiencies, as most people believe, and it wasn't machine learning or AI maths at all. They did use that as part of their market making activities. They were actually market makers and virtually did scalping like high frequency traders. That's basically, they were like Citadel, but they're a hedge fund. That's where most of their money actually came from, and that's where the Markov analysis came in. It gave them an edge to predict the price just before people bid and asked, and they got in and scalped the cents. So yeah, it's not at all as mysterious and remarkable as it sounded. Probably the greatest quant ever was Ed Thorpe, and there are others who are not as well known. He's probably the most well known, and he's not that well known. William Ziemba's pretty good, but he was an academic all his life and only traded as a hobby. But he was a friend and associate of Ed Thorpe's, and they did a lot of interesting things together. There's lots of others. Andrew Lowe is an academic. He's done great research. These weren't option traders. That's trading generally. So I'll get off the topic. Anyway, I'll continue the series and I'll stop now. I've been going on too long. Okay, thanks. Bye.